Good morning, traders. Good morning. Let's get ready for some poker. Get ready for some poker, guys. You ready for some poker? Yeah. All right. Where are you guys from? Talk to me. Ooh, wow. Look at that. My God. We're from all over the world here. That's just insane to me. Insane. It's insane to me, guys. Wow. Not too long ago, it would take us an incredible cost, a tremendous amount of time and travel for all of us to come together like this. Now, I know nothing truly replaces that energy and magic that can happen um, in a live setting, but it's certainly better than nothing. Wow, amazing. So, traders, today I wanted to talk to you about something that is really not in your cards per se, a concept that's not really a part of your cards per se. The items are, but the concept behind the items aren't. And it's something that I want you to be aware of. Right. So I'm actually, to demonstrate this concept today, I'm going to actually use a 15-minute chart of Bitcoin that I recently snapshotted, actually, just a little while ago. And it doesn't really matter what we use, because as I'm constantly reminding you, all concepts, traders, all of them are universal in terms of, trying to grab this right here. All of the concepts are universal in terms of their 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 use in time and market. So everything that I speak to you about can be applied to any time frame, right? Time does not, the changing of a time frame does not change the concept, the strategy, the technique. The truth behind what I teach you is not altered by changing your screen. Remember, traders, that remember that when you change a time frame, you're changing only your screen. You are not changing the truth. The truth is the market. You're not changing the market by changing a time frame. You're changing your screen. So you're changing how the screen reflects that truth to you. But the truth behind the screen is never altered. And so the trading concepts that I teach you are based on the truth behind your screen. All right. Do you follow what I'm saying? And so please understand that when you go from a 2-minute chart to a 5-minute chart, all right, or a daily chart, even, you're not changing the market. You're changing how you choose to see the market. The market's not changed. And I'm constantly getting that question. Well, Oliver, does this work in the 15-minute chart? Does this work on this time frame? Like, of course it does. That's just your screen. You're manipulating how you want to see that concept play. All right. All right, guys. Um, I don't know what to say for you guys. I mean, uh, volume issues are usually on your side. So can you turn the volume up? That's right, Chris. It only works in the past. Sound is good, right? Sound is good, guys. All right. Yeah, guys. That's become an inside joke because one of my VIP trading my VIP um um VIP trader my VIP trading club members, one of them, I guess he was frustrated. He wrote that, that Oliver's concepts only work in the past. They never work in the present. And I'm like, really? And then someone said, yeah. I still crack up at that. I'm like, dude, the past was the present. What are you talking about? You just have to practice being there. That's all. It's funny how the frustrations of trading can get you to look at everything else except yourself, right? Like it's so painful. And I get it. I understand. It's so painful sometimes that it's like you relieve yourself of that pain by pointing to something else. These things work perfectly in the past, but they never work in the future. They never work in the present. Yeah, you too. Mm. All right, okay, guys. So so look, for all of you short-term oriented traders, I do want to let you know that the three short-term time frames are the 5 minute, the 2 minute, the 5 minute, and the 15 minute, right? And these these are your short-term time frames. For training purposes, I encourage the 2 minute because that would give you the greatest number of experiences. And we know that your success is on the other side of your experience. It can't be before you become experienced. All right. So that's why I focus primarily on the two. But if I were to focus just on money, it would be the 15-minute time frame. So the 15-minute time frame is your biggest money making time frame when we're talking about short-term oriented trading. All right. You won't make more money than you won't make more money trading another time frame short term than the 15-minute time frame over time. All right. So please know that. But if you train on the 15-minute time frame, you're going to extend the point at which you can call yourself a sufficient trader. You're going to extend that years out. That is not what you want to do. So while you might be able to take some trades on the 15-minute, and I encourage that, but don't exclusively trade the 15-minute because you're just slow. You're now your experience building has gone to being very slow motion. We can't afford that. All right. So mix it up, but predominantly trade on a smaller time frame so that you get more experiences under your belt. That's the most important thing. Now, um, so we're looking at a 15-minute time frame of Bitcoin. This was snapshot just a little bit before 9 or 7 o'clock. I can't remember, something like that, seven something. And of course, you know that the two main moving averages that I encourage that you have on every single chart is the 20-period simple moving average. That's your blue line, and the 200-period simple moving average. That's the red line. All right. Now, the concept that I want to share with you is based on these two moving averages, of course. But first, let's cover some basic things about these two moving averages. All right. Oliver, can you tell me why the 15-minute is the moneymaker? Um, because you get the most enduring trends, right? So you're going to get the most enduring trends where um, a 2-minute would knock you out of the trend faster. A 5-minute would knock you out of the trend not as fast, but faster than the 15, and the 15 would keep you in the trend longer. All right. Now there's the other side of that where your losses are bigger, but your gains should tend to be exponentially bigger than your losses. All right. If you play correctly. All right. So let's cover some basic concepts about the 200. And I suggest that you take these down if they are, especially if they are new to you, if you're hearing this for the first time. First of all, let's take the 200 period moving average. The 200 period moving average is at its strongest and most powerful. Well, first of all, the 200 period moving average is the granddaddy of all moving averages. It is the most powerful moving average of all. All right. And as we know, if a stock is is above the 200 and drops to the 200, there will tend to be the 200 will tend to be at least temporary support. So there will tend to be some halt and rebound of some sort. And that is what you see here. Let me show you. So we start from above the 200. We come down to the 200, and there is some reaction off of the 200. Okay. So the 200 will tend to have some level of support if you're coming from above it. Oftentimes, when you're coming from beneath it, it will tend to have some resistance and some reaction, although it didn't do that very much here. Little bit, but not much. Okay. But that's very basic. Now, the flatter the 200, the more powerful. So you see how you can tell kind of over on the left, the 200 was sort of rising, but it got flat here. The flat 200 period moving average, for whatever reason, is more powerful as a support and resistance item than a slightly rising or slightly declining. But keep in mind that the 200 is always powerful. I'm just talking about the flat 200 is its most powerful. Okay. I want you to also understand that the chart would have you believe that the 200 is very thin like that. But in reality, the 200 is more like a zone. It's a support and resistance zone. So look at it more like a fence you can lean on, or a trampoline you can bounce on, or better yet, boxing ropes you can lean against. So this is not really a break of the 200 per se. It's a lean against the ropes, and the ropes swing the trader, swing the stock back. So we press up against the ropes and get thrown back a bit. All right. That is exactly why it means that, Itor, because a flat 200, a flat, guys, in order to get a flat 200, you must kind of have equal life above the 200 and equal price life below. Does that make sense? That's how you get a flat 200. They're like 50% of the stock's life in recent history was above the 200, and 50% of its life is below the 200. Does that make sense? Yes, no, maybe a little bit. Let me know. A few of you. Yes. Okay. That's how you get a flat moving average, right? Okay. Good. All right. So your stock is basically neutral from a 200 perspective. All right. So it's important to understand that in order, remember, a moving average is averaging out the price activity. So if a moving average goes like that, that means 50% more or less has been above the 200, and 50% of the stock's life in recent history has been below. But that's based on the 200. Now, here's something interesting. So we've got this flat 200 here, which means that from the 200's perspective, the stock is flat. All right. But from the 20 perspective, a shorter time frame, it's not flat here. Okay. And that's what we're going to really talk about today. Now, we've covered the 200 being flat, being at its strongest, but also that it is not just a skinny line, it is a zone, if you will. So don't get confused and think that this is a true break of the 200. It's just a press up against the zone of the 200. This is not a break of the 200. It's just a press up against the zone of the 200. All right. All right. So now let's take the 20 period moving average. Okay. The 20 period moving average is, in my opinion, the most important short term moving average. Now, the 200 is a long term moving average. The 20 is the short term moving average. And whenever you're using a dual moving average system, you should be using a long and a short together, not a short and a short together. All right. I mean, as a staple, we might bring on a short one too, but the two staples should be long and short, and that's what we have. So the 20 is our short-term moving average. And the thing about the 20 is that it too is a zone. So don't think of little tiny breaks like this as breaks. This is just leaning up against the zone of the 20, right? It's not really breaking. It's leaning up against the ropes. The ropes bend, ropes have leeway, and you can lean on the ropes without truly breaking them. So keep that in mind. And also keep in mind that the 20 has support and resistance qualities as well. So when you are under a 20 period moving average and you move up to a 20 period moving average, there is a decent likelihood that there is some reaction off of it. If you are above the 20 and you drop to the 20 period moving average, there is a decent probability that the stock has some reaction off of the 20 period moving average. And this sets up some really wonderful trading opportunities. All right. This is one of the reasons why I tell you that if you can, well, let me just do this. The other thing, and I'm going to come back to that. The other thing I want to mention about the 20 is that the, while the 200 is the most powerful when it is flat, the 20 is most powerful when it is rising or declining. So the 20 period moving average is the most powerful here on the upside. And that is when its supportive qualities are at its best. When the 20 is declining, it is also powerful. And that is when its resistance qualities are at its best. So the 200's support and resistance qualities are at its best when it's flat, and the 20 period moving averages support and resistance qualities are at their best when it's trending up or down. All right. Now, this is what sets up sound market play, traders. If you're playing, if you can ensure that your most of your entries, long or short, or at or near, are at or near, that's important, not at all the time, but near, at or near one of these two moving averages, you will radically improve your trading. Radically. So this is very general. Just every time you enter, almost every time you enter a stock, almost, not every time. I'll get to that in a second. Almost every time, let's say 80% of the time, if your every entry is near either the 20 or the 200, if you can do that, you can ensure that the vast majority are that way, you will radically improve your trading. Now, that's number one. Number two, if you're playing near the 20, If you can ensure that not only that you're entering at or near the 20, but you're entering at or near the 20 in the direction of the trending 20, you double your accuracy rate. Double your accuracy rate. I'm going to say it one more time. You're going to double your accuracy rate. The 20 is like a river. When it is trending hard, it's like a strong current downstream or something. And if you just dive into that current, the current is usually so powerful, it'll just take you away with it. You can even enter wrong right there. That's wrong because you're entering too far away from the 20. And it still works because the current is so powerful, right? Usually. And so these basic things based on these two moving averages, making sure that most of your entries are at or near one of these moving averages, making sure that if you're playing near the 20, that you're playing with the trend of the 20 and not against it, unless, right, unless you're far, and that's a different topic. This is far, which means the 20 is no longer relevant. It's too far away, right? But it's not far. We want to play with the 20. All right. Now, we've got the basics out of the way regarding these two moving averages and how they can improve the accuracy of your trading. Now let's get to the main concept today. I want to talk to you about the 20 MA squeeze. The 20 MA squeeze. Now, I told you that when the 200 period moving average is flat, it is at its most powerful, right? But there is an exception when it actually will get run over in most cases um, by a freight train. And it's when the 200 is flat, right? Let's do this like that. The 200 is flat and the 20 is rising under the 200, narrowing the space. So wide, less wide, less wide, less wide, less wide, less wide, right? So the 200 is flat, the 20 is rising, and the price is trapped between both, like a ping pong ball, right? If the 20, here's the key, if the 20 is containing the price activity, meaning it won't let the stock break, it's saying, nope, you got to stay within my control. If the 20 is controlling the price, it's going to throw the price above the 200. It's going to overpower the 200. So it's almost as if the 20 and the stock have joined forces together to overrun the 200. And the reason why this is important is because I need you to understand when a I need you to understand that a flat 200 is very powerful, but I need you to understand when it's when the ex, when you have an exception to that fact. Exception to the rule is when the 20 is rising back toward that 200 and it's controlling the price, the 20 wins, not the 200 most of the time. Tell me you understand this. The 20 is going to get, the 200 is going to get overrun most of the time. Why is this important? Because if you've got this scenario, let's say, for instance, traders, that you have bought, this is one of your cards, a bull 180. See that bull 180 right there? Boom. Now remember what you can do with tails. You can erase them if they're sizable to get a clearer view of what you're dealing with. So we have a bull 180 scenario right there. Boom. Right off the 200. I mean, right off the 20. But you say, well, Oliver, why would I take that? Well, the 20's rising. Yeah, but Oliver, I'm under the 200. Why would I take that? I'm in the trap zone. No, why would I take that? Because you've got this scenario. You've got the exception scenario. You've got the flat 200 above, but you've got the rising 20 period moving average that's giving you a buy signal, and it's containing the price activity. And so the 20 and the price are ganging up together to overrun the 200. So in this case, you wouldn't be afraid that there's resistance above, not in the 20 period moving average squeeze. All right. Now, let's take a look at the 20 period moving average squeeze in reverse. Here we go. Drop, boom. The 20 contains the rally, just like the 20 contained the drop. It throws the stock back down. Boom. I would dive right into that bear elephant bar. That's one of your cards. Bear elephant bar. Boom. But Oliver, the 200's there. Aren't you afraid that it's going to be support? No, because the 20 is squeezing the stock between the 200 and the 20. The stock and the 20 are ganging up together to crash through the 200. All right. Isn't this the no? Jarina's asking, isn't this the same as the 20 MA halt? Well, no, it's not. Because what if the 200's not there? That's a 20 MA halt. But with the 200 there, it's something more. It's the 20 MA squeeze. All right. So, you know, you could have a 20 MA halt with the 200 up here somewhere. And that's just a plain 20 MA halt, right? And the 200 has nothing to do with that. But in this case, you got the 200 close. And so a lot of traders miss opportunities because the 200 stops them. But I don't want it to stop you in this squeeze scenario. All right. Um, and there are times when, like, guys, there are times when this price will get squeezed so tight like that, then it takes off. Right. Uh-oh, Antonio, he did it. You see Antonio's question? Oliver, how do you know when you're too far away from the 20 for a snapback? Can you give me a measurement? Can you give me a number? Is there a ruler that you have? Is that on olivervelezstore.com? The trading ruler? Teasing you, Antonio. Um, this is the I always say this is the adult mind, right? Coming into play where when I've got we got like 600 trading kids right now. Um, and my kids never ask things like that, right? When I tell them, tell them to look at this chart and say, find the places where this stock is way away from the way away from the red line. And they'll say up here is way away. They'll say up here is way away. And they'll say, here is way away. And I'll say, well, okay, we'll find where the stock is way away from the 20. And they'll say, right here is way away from the 20. And right here is way away from the 20. And they won't ask, like, well, can you tell me how far is far? They just look, right? So everything is relative to your stock. If I were to give you a set number, that number would not be applicable to the next stock. The price range is different. The volatility ratio, the, the volatility range is different. So you have to visually say, is there a lot of white right there? Is there a lot of white? That's it. Relative to the stock's history, right? So there is a level of subjectivity to it, but it's really not that hard. So if I were to ask you, is this far? Is this point far, far versus this point? And you would say yes. Boom. You wouldn't need a ruler, a ratio, formula. Right? Got it. All right. So, um, where was I? Eric is saying that, well, just change my trading. Many times I don't take these for the full ride because of the 200. That's right. That's a great point, Eric, because some of you are letting the trade go at the 200, which is not bad because you think it's going to stop. But maybe you let only part go if it's a squeeze. All right. I like that, Eric. This is the new goal. We should actually change that. This is worth Bitcoin. I mean, we are in a Bitcoin chart, right? So, guys, in traditional technical analysis, this is traditionally called a triangle, right? Or I don't know, a wedge. I forget what these names are. It's like your stock, like this. Your stock is doing this, right? Wedge. Boom. All right. But see, in traditional technical analysis, that's just price. There's no moving averages associated with this pattern. I'm giving you a wedge based on moving averages. So here's the upper part of the wedge, and here's your rising part of the wedge, and your stock is trapped between. Boom, right? So always think of this. Think of it, always remember this. When you have something flat and something's rising to it, the rising the rising element will win. So even in traditional technical analysis, when you have a stock it rallied, then dropped, rally, drop less, rally, drop less, rally, drop less. So you see this is rising, but this is flat. The rising wins most of the time. Same thing in the moving average. Flat 200, rising 20, the rising element wins. That's the locomotive. So one is stationary, the other is sneaking up behind the stationary, boom, and it knocks the stationary out because it has momentum and the stationary doesn't. Does that make sense? The locomotive building up power and steam to blow past. All right. So the rising element, when there's something flat, either flat highs or flat moving average, And rising lows or rising moving average, the rising element wins, right? So remember that. And so if you got in here and you take profits there, that's okay. Just don't take it all. What if you recognize this as the 20 MA squeeze? All right. Now this squeeze is beautiful. I love the squeezes that ignite. So you got an igniting entry before the true squeeze. This is the entry, the elephant bar off of this squeeze is your entry. So this is just clear and it's all right, beautiful. Now, Bitcoin does tend to produce a lot of bear 180s and bull 180s. So here's a bear, here's a bull 180, bear 180, bull 180, miniature bull 180. You know what I mean? Bull 180. It produces a lot of them. All right. It also produces a lot of tails. So, and it just produces a lot of everything, guys. You know. Um, but yeah, so I just wanted to use this chart to share that concept with you. So, what questions do you have? Beautiful volatility. Some people have a problem with Bitcoin's volatility. Like, but isn't I mean, I don't. I've just never gotten that. I never got the fright from volatility, right? I mean, I started my career on Wall Street as a Nasdaq market maker, right? And we made our living off of volatility. Like our living would get very reduced in markets with no volatility. So I just lived my whole career wanting volatility, using volatility. So, and Bitcoin's volatile because it's a free market, right? Anything that's not volatile is a controlled market, a manipulated market to be not volatile, to be almost not alive. So because you can't control Bitcoin, it's an open market, it's going to be volatile, you know? But volatility works, guys. So remember, I told you that in order for you to have a flat 200, you have to have the stock spend some time above and spend relatively equal time below. That's volatility. And so if you are an accumulator of Bitcoin, when do you want to do it? You want to do it away from the 200, right? Does that make sense? If you're just if you worked for a firm, right? So you work for a professional firm. You got hired by this hedge fund that they give you your instructions. Look, here's here's 30 million. All right. Your job is to just put the whole 30 million in, not all at once. You've got to try to accumulate this thing, right? At at the best prices. All right. So, take your time, but let's get it all in. So what you would do is you'd use the volatility. You'd wait for breaks below the 200 and you'd start accumulating. Above, you chill, right? And that's you would use the volatility to your benefit. See, there would be no question as to whether you should buy or not. You have to get the 30 million in. So now it's just okay, what's the most opportune times when I'm on the opposite end? And when I'm on the positive end, I like not lighten up my position, but I lighten up my accumulation a bit, right? And so the other thing with volatility is that you're supposed to run a line through the volatility. So um, Bitcoin is an 80 vol asset, right? That's what it's called in the industry, an 80 vol asset. So what's the median line? 40. So you draw a 40 line through the volatility, right? Now, this is the direction of Bitcoin's history. Its whole life. It has never stopped that, right? So you've got you run a line through the volatility and you buy these. You buy on the bottom portion of the volatility line, right? And then you make volatility work for you. The other thing, remember, did anybody see my tweet yesterday? It's the lows, stupid. Did you see that? It's the lows, stupid. Anybody see that? No. You guys don't follow me on Twitter? Yeah. You don't follow me? You should. Anyway, um, a lot of people don't realize that. A lot of people don't realize that you're supposed to judge an asset by its lows, not by its highs, right? But everywhere you hear is that the market's off 4% today. What is that? 4% from the high. Bitcoin's down 45% from what? The high. We're up 12% over the past month. All right. That's from the prior. That's the high down to the prior close. But the way you properly look at an asset is its lows. Right? And the highs don't the highs give you information, but not base. They don't give you the most important information. All right. All right, cool guys. Any other questions here on this concept? Anything? You have your assignment, guys. Look for these things this week. Don't just come here, have a lesson, and just move on as if it didn't happen. Oh yeah, that was a cool session with Oliver, and then boom, it's gone. Right? Make this a goal Monday through Friday to capture these. And you know what you should do? When you capture one, take a snapshot. This is a snapshot I took of this. This is an image. Create a folder on your computer screen, on your desktop or something. Create a folder and name it 20 MA squeeze. And then whenever you capture one, wow, that's a cool 20 MA squeeze. Take an image of it, drop it in that folder, and collect them. You should actually have folders for every one of your cards or for most of your cards. And you should collect images that match those cards. Guys, I used to do this manually. Do you understand? I had file cabinets. I had I had multiple file cabinets filled with images. Guys, I started in this business when there were no charting platforms. Do you understand? I Some of you know the story. I subscribed to a service called Mansfield's Charting Service. It was a subscription. Every Saturday, right? I would get this big package. I would wait for it. Every Saturday, big package delivered to my door. I'd rip it open, and it was literally 5,000 NASDAQ stocks in charting form and 1,500 New York Stock Exchange stocks. So it actually came in two packages. So the 5,000 stack was NASDAQ, the 1,500 stack. Now, it was just And your initial order came with two things. Your initial sign up order came with a binder, right? And a magnifying glass as a bonus. That's right. You guys remember the story. Came with a magnifying glass because the charts were, you'd get this sheet, right? With like 50 charts on it. But the squares for each chart, like you're looking at a square of Bitcoin here. Just think of that square being really small and in the upper left-hand corner of a page with 50 more squares. And so you needed a magnifying glass to really see detail. But you had this binder. It came with a binder, and you put the NASDAQ, you put the New York Stock Exchange on top. There was a tab sheet that separated the NASDAQ from the New York. And each week, when you got your new set, you throw the old one out because it's the same charts, right? And it's crazy. But then when charting systems came into existence, I nixed that and I became my own Mansfield's charting service, right? So I would collect the images of each of the patterns I played, hundreds, sometimes thousands of them. And sometimes just randomly, I would sit down and just take a folder, 20MA squeeze folder. Let's say I've got 450 sheets in that folder, and I would just flip through every single one. And do you know what that did? It made me such an incredible 20MA squeeze identifier that not one would ever get by me. It also made built up my confidence because by seeing so many of them work, it's like when you see it live, there is no doubt, there's no hesitation. You've seen thousands of them already. You don't need to be nervous. You don't need to hesitate. You don't need to doubt, you know? Dorina, you wish I could digitize them. Man, we're talking like 80s, 1980s. Digitize what? Oh, you mean the pieces of paper? I'm just trying, you know what I'm trying to find? I'm trying to find, you guys have seen the images of me building my first trading office. I'm trying to find pictures of it finished though. I know my sister-in-law might have something, but I haven't been able to find that. You know, guys, Danielle's asking a question here. Let me see. Oliver, would it be wrong to sell the red topping tail on the 20MA? No. But first of all, you mean to sell into this? It's green when you sell, right? Right. So you're selling on the way up. If you're going to sell on the way up because you're far from the 20, and it becomes a tail after you sell. But because this is a squeeze, I wouldn't sell all of it. That's the whole point of today's talk, right? Is look at what you miss. So the whole point is sell if you want, just don't sell it all if you've got a squeeze. All right. So, guys, I created my own encyclopedia of trading opportunities. You know, Kel, don't do it to me. Don't do it. I started our talk off with this point. Which time frame is best? There we go. There is no best time frame. Whichever one you want to trade. You're not changing the truth by changing the time. That's only on your screen. You're changing your screen. It has nothing to do with the market. right? What kind of computer do you have, Kel? He's still asking. 2 or 15 minute. Well, what kind of computer do you have? Lenovo. Okay. So do you realize that when you change a chart from a 2 to a 15 minute, that you are not changing our computer screens? You realize that, right? And you realize that you are having no effect on the actual stock, right? So then where is that change happening? It's happening on your Lenovo. And so does that affect anything? No. So the point I'm trying to make is that what I'm teaching you is a truth that is applicable in the actual market. So pick any time frame you want to trade. Now, what I think a better question is which time frame should I trade? Not which time frame is this tactic the best on. No, what time frame should I be trading in? And I went over that today as well. All right, if you're in training mode, 2 minute predominantly, sometimes 5, and sometimes 15 if you like, but predominantly 2 because you want experience. A 15-minute trade might last all day. Like that's one trade. Like you're not going to progress taking one trade a day, guys. It's not going to happen. You understand? Not going to happen. Right? So you need many opportunities. The other thing, guys, you can't you can't worry about winning and losing right now. And I know that's it's a strange dichotomy that like you're trying to win, but you're not supposed to focus on it. Right. And for this reason, because that's so strange, I used to, when I had trading offices, I would have these drills where it was losing day or losing morning or losing afternoon or something like that. A lot of times it was in the afternoon. So I'd be like, all right, guys, look, over the next hour, you have to lose money. They'd be like, what? Al? Yeah, you have to lose money. I said, listen, anyone who makes money over the next hour, you're done for the day. And then I would make it even stricter. You've got to lose exactly $51. Now go. Do you know how skillful you have to be to lose exactly $51? To time it perfectly? You have to figure out, okay, do I do this with 200 shares, 100 shares? Do I start off with 200 and then pare down to 100 to get the 51? Like it brings in all the skill sets of a trader, but it also gets them focused. It's sometimes when you switch something upside down, you see it clearer, right? And having a trader focus on losing properly flips the picture, flips the script upside down. But my point is that you can't become good unless you have become so acquainted with every possible way to lose that it no longer has a grip on you. So in order to do that, you have to lose a lot. But when you're focused on just winning, losing a lot becomes a problem. And so you create the conflict that it's really good for you, but you psychologically feel it's bad for you. And this is a problem. You have to lose. It's the only way to get good. It's the only way to become experienced. You're good at losing, but you fear it. Yeah, I mean it's it's natural. It's natural. Guys, my progress The first time I felt a change, a shift of some sort, I'd never felt it up until this point. I literally couldn't believe that someone could be so bad at a thing. But I used to laugh at myself sometimes, like just so because I would get tired of crying. And then sometimes I would be so bad that it was laughable. Like I would just have to laugh, like the Joker. You know, like that. I was going insane. And so, uh, but the first time that, the first time, I'm sorry for your cats that jumped or something like that. But the first time I felt a shift, all right, is when I started seriously accepting the possibility of being a bum. I mean, people think when I say that I'm playing, but I thought this through. Like, I started accepting that there might be a possibility that I'm never going to be good at this, but I still love it. So if I can't make it in life, but I still want to do this, I start saying, well, the best place to kind of be homeless is Miami. And um, I could do side jobs or whatever. I started thinking like that. Now, you might think that that's defeatist, but it was liberating for me. And I started thinking like, there are so many, like, so what if I'm never good at this? I love it. I mean, it makes me cry, but I wake up every morning wanting to do it again. And isn't that better than sitting? Because, you know, my training is as an accountant. Isn't that better than sitting in some freaking cubicle somewhere with pictures on the wall of the cubicle, your jacket thrown on the back of this of your swivel chair, and your boss walks by and you jump and with an erect back and start typing as if you were busy all the time, like freaking living your life 40 years like that. Isn't that better to wake up and want to do what you love to do, even if you're not good at it? And I started reasoning that way. And I'm like, because guys, when I was in college, I caddied, right? I caddied at a country club. All these rich guys playing golf. And let me tell you something. They were freaking horrible. All of them. They would freaking rip up the field. Beautiful field. By the time they finished, it was all freaking ripped up. They would come back every single week, and rip it up again. They loved it, you know? And that didn't stop them from doing it, that they were horrible. And so I started thinking, why should I stop because I'm bad at it? And that's the first time I felt a shift. It's like what Patrick was saying, that I should practice this because I'm it's easy for me to lose, but I fear it. That's when I stopped fearing, because I realized that the fear was making matters worse. I was fearful that I wasn't going to make it. My God, I'm not going to make it. Then I'm like, well, so what if I don't make it? I'm still going to do it. Just like those golfers, man. They never made it. And they still come up every week to rip up the field. That was the first time I started feeling progress. Now, guys, I never realized going through the process that losing was the right thing to do. All of this was realized in retrospect. But your benefit is to have me tell you so that it's not in retrospect that you have to lose, that you have to lose your life to gain your life, that you have to become so intimate with every possible way to lose that it no longer frightens you, that it no longer has its grip on you, that you have to go through every type of loss so that it goes against you. You know what a key of tunnel is? So when you're fearful of the tunnel, the tunnel stays in front of you. But the victory is on the other side of the tunnel. So you have to go through it. You have to go through the tunnel and you have to keep going and don't stop until you get to the out the other end of the tunnel. And when you get out the other end of the tunnel is now behind you. Now think of every single possible way to lose as an individual tunnel. You got to go through every possible way to lose. Go through that tunnel and you got to keep going. You might have to lose with it, lose with it, lose with it, lose with it until you get to the other side. And now that way to lose is behind you. You have to do that with every single one. Now that's becoming intimate with loss. But when enough of those are behind you, my God, it gets really sunny. It gets really sunny. Do you follow what I'm saying, guys? Vic says, Vic is asking, how can you stop thinking investing when trading? That's pretty easy, Vic. Just stop. Stop it. Don't do it. Got it? Yeah. But I'm curious about that. Like, what do you mean you're thinking investing? Can you elaborate on that? Like, what thinking investing how? Like thinking about like um company products and what their next earnings report might be and what do you mean by thinking investing? Thinking about the company's products and stuff? Is that it? So you have a problem with holding plays too long? Mm, do you, do you experience a lot where you have gains that disappear? Like a lot of your gains disappear, and that's not enough pain for you to stop it, to stop holding too long? That's not enough? I mean, guys, like 85% of a problem's solution is in recognizing that it's a problem, right? Seeing it. The problems that are really nasty are the ones that exist, but you have no idea that you have a problem. You don't know what, or maybe you know you have a problem, but you haven't identified it. You don't know what it is. Oliver, I don't know why I keep losing my gains. I have no idea. But Vic is saying, I keep losing my gains because I'm thinking of investing. Well, then you know what the issue is. So fix it. Stop thinking that it's an investment. Stop freaking getting married to bars. Think of it as bars, man. Think of like if a bar is away from the blue line, I'm taking profits. I'm not holding it. bars away from the blue line, I'm taking profits. I'm not going to marry it. It's not my wife. I don't want it to be my wife. Talk to yourself, Vic. Talk to yourself. Wake up in the morning, when you're brushing your teeth, brush your teeth, all right? Spit out, rinse, dry, and then repeat in the mirror, I am not going to marry my stocks today. And say that like 5 times. I am not going to marry my stocks today. When they are far from the 20, I'm taking profits. I am not going to marry my stocks today. And do that, Vic. You got it? It is a good idea. How many stocks, how many trades per day would you recommend for us to perform? Um, like it, every day is going to be different, but I like 3 to 5 in that range. You know, sometimes it might be more, sometimes it might be less, but if you're getting 3 to 5 trades in there, you're okay. And if you combine that with taking snapshots of things that you didn't trade, so for instance, like you take a snapshot of that play right there because it's the squeeze play off the 20 and it's an elephant bar, that's absorbing a portion of it as if you traded it, right? Um, so, if you combine the 3 to 5 with things like that, you're going to make some decent progress. All right, guys. I don't want to spill over into like 50 different concepts we cover here. We'll get through them um, one by one over time. All right. If it were possible, you are softening the blows of losing. Barbara, yeah, that is part of my mission, which is to truly make you understand, which I realized in retrospect, that you're not sup- that you're supposed to lose. Like you're supposed to. And in fact, if you win, and you're not really, really, truly experienced and skilled, what is that win? Luck. And that's your worst enemy. Luck is your worst enemy because you are going to get freaking killed, you know? So you don't want luck, all right? You don't want it to come free. It has, that's what, that's what the Bitcoin proof of work protocol is all about. When you have if you get a full Bitcoin at $39,000, that is proof that you put in work, right? If you mind it, man, you expended a lot of energy to get that Bitcoin. If you bought it, you put out a lot of $1,000 Bitcoin. That's proof of work. Nobody gave it to you. No one gifted it to you. You weren't born with it. You put work in to get it. Proof of work. That's the proper way, right? Same thing in your trading. You do not want your gains to come without work. You do not want luck. You do not want your gains to come before you have put work in to become skillful, to become experienced. And when your gains are after experience, when your gains are after you put the work in to become skillful, that's when it's proper. That's when it's in alignment with the universe. That's when it's true. That's when it will be lasting. But if it's gifted to you by luck, I promise you, you will have to pay a hefty price for getting something that you did not deserve. It may not come right away, that price will have to be paid. And it's usually paid in a very nasty way. Traders, I love you to death. Enjoy the rest of your Sunday. All right. We're back at this game tomorrow. And remember, put in the work. Ciao for now.